Okay, so let's talk a little bit about M&A. Okay, so the whole basis of M&A is obviously, I think, quite obvious. You wish to grow. There's obviously two traditional form of growth. There's obviously organic growth. You just kind of reinvest your internal resources, and you grow in that respect. The obviously the perhaps the other way is obviously by buying other businesses to expand. So they say that there is a slight difference between acquisition and between a merger. So in an acquisition, the acquiring company purchases a controlling interest in the target company, and the acquiring company retains its name and its identity, but brings the identity of the target company to an end, right? So effectively, you buy an underlying company, and you essentially integrate it, and it forms part of of of, uh, of company A. In a merger, effectively, they're saying that both companies really surrender their shareholding in the companies to be merged into a new company. So A plus B equals C. In this one, A acquires B and remains A, right? So, yeah, yeah, you never have a true merger, right? So you'll never actually have a 50-50. Exactly. Yeah, there'll always be one dominant over the other. So, okay, so what we can have is what's called a statutory merger. So effectively, what they're saying is that you acquire the assets and the liabilities of the company, and after the merger, the target company no longer exists. Um, in a subsidiary merger, the target company becomes a subsidiary of the acquirer. So to the extent you wish to acquire some piece of special technology or RP or specifically a brand, you may acquire that business. And then they talk about consolidation. So where as Shane was just referring to, notwithstanding the fact that it may be called a merger, where A plus B equals C, uh, yeah, they're saying that both companies will actually cease to exist and a new company will be formed. So, okay, so just a few things. A horizontal merger. So essentially, you acquire another competitor in the same industry. You essentially expand your market share um, horizontally. Vertically, you may go back in the supply chain and effectively acquire another company up or down the supply chain, right? So, um, yeah, they decide that, as an example, a company that makes specialist breads for bakeries may decide to purchase a flour mill, right? Give them access to a consistent supply of flour. So, so I think that particularly where the value chain is changing, right? I think we see a lot of vertical mergers. Um, and then what used to be quite popular, particularly back in the 1960s and 70s, was consolidation, conglomerate mergers, right? So effectively, a company may think about they want to diversify their risk base. They think that by having different forms of revenue or different risk profiles of earnings, they can diversify within the company themselves. So what that led to a lot of conglomerates. Uh, but this is not that popular anymore, right? So a lot of shareholders say, look, I can just diversify at the shareholder level. I don't need you at the company level to diversify for me. So so conglomerates are not as popular anymore. It was actually quite popular in apartheid South Africa because we could not buy we could not take company capital outside of South Africa, right? So a lot of companies just ended up buying companies inside South Africa and becoming conglomerates. Um, Common motivations behind M&A strategy. So synergies, obviously you get revenue synergies and you get cost synergies. Which one is the easiest to do? Do you guys think? Huh? Any thoughts? Yeah, you get revenue synergies and you get cost synergies. Do they say it here? The cost is the most certain, right? So as soon as somebody says, look, we're gonna we're gonna just buy this other company, and because of that, we're just gonna be able to sell to their new people. We're gonna jump our revenues. Never happens, right? The only thing that you can do is fire the other people. So cost synergies, right? You take employment costs out of the system, cut their costs. It's the only thing that you actually have control over. You do not have control over other customers or their customers, right? Revenue synergies are a lot more difficult to implement. Growth. Obviously, if you're looking to generate further growth, interesting. I was chatting about a potential merger today with one or two guys, and they were saying that they were involved in the way that media is now being consumed through mobile. People, particularly broadcasters like the ETVs, SABCs, they are losing their power in the market because now people just access the content through mobile phones and through tablets and so on. So he was saying that a lot of these guys are now realizing that if they just stay as they are, they'll become obsolete. Yeah. So effectively, not necessarily to grow, but just actually to remain valid, remain. So I thought that was quite interesting. That either if they just stay where they are, ultimately they go backwards. So they actually have to acquire in order to go forwards. So and then obviously increasing market share, right? So funny enough, when I was studying CFA, I used a service provider called Stalla. I don't know if you guys have heard of them. Yeah, Stalla. So I used to use Stalla. It was acquired by Schweizer. Schweizer acquired it and then shut it down. So just to try and take competition out of the market and increase market share, I thought that was quite a different strategy. So buy a company to shut it down. Yeah. So okay. Acquisition of unique capabilities. I think that's obviously quite a key piece. So to the extent that you have certain IP, you have a very strong sales force. So for example, Bank of America, when they acquired Merrill Lynch was known to have a very big brokerage force, right? Very strong. If you needed to move stock in a quick manner, they were known as the Thundering Herd, I think it was called. You effectively had all these brokers. They would pick up the phone and they would essentially, almost like Wall Street, they would start pushing the shares on their clients. So to the extent you want to acquire some specific people, you've got to be quite careful of this because obviously, do you know that Edge used to be Forbes Lever Baker, right? So Forbes Lever Baker was bought by Avitech. So they bought the creative talent and then the creative talent left. And then, does Forbes Lever Baker still exist today? So, yeah. Did it? Okay. So if you acquire the creative talent, make sure that the creative talent stays in the business. So restraint of trades, certain incentive schemes, try and migrate that. You needed the guys like Charles and Steve to essentially, coach, and teach, and essentially try and move the business away from being a people-centric business. So diversification for conglomerate mergers. This was quite popular. Diversify their investments. So I was wondering if Taste Holdings, Taste Holdings, they bought essentially out of Domino's and Starbucks. They then went into Natal Wholesale Jewelers. I think that they tried to say, look, Natal Wholesale Jewelers is also a franchising business, and maybe it provides us a bit of a different or diversification of our earnings base. I don't know. A lot of guys would say, look, you don't have expertise in that business. Maybe you should stay away from it. Rather, let the shareholders. Conglomerate diversification is not believed to add value to shareholders. Shareholders can diversify their own portfolio, right? So why do you need to diversify? Typically, that's seen as empire building, right? Bootstrap earnings, so very popular in the property space. So when you have something like a Growth Point or Redefine trading at a very steamy PE multiple or a high yield, they would essentially issue shares into the market and essentially absorb those earnings. And because of that, the earnings per share should actually there should be an accretion or an appreciation of the earnings per share. So let's take a quick look at this example. So Quara A has stock price of 100. They're going to issue their shares at 100. They are going to acquire all of the shares of Target. The Target T. So let's see. So the purchase price is obviously the market value. So the market value of the value per share of stock A at 100 means that they would have to issue 25,000 new shares. They previously had 100,000 shares. So in total afterwards, there'll be 125,000 shares outstanding. if we just add up the earnings, 400 plus 125 gives us 525. 525 divided by 125 means that we have earnings per share of 420, and you can see how that compares to our original earnings per share of 4. So essentially, you are trading on a high PE multiple, and you're buying something that's on a lower PE multiple. So, and you're issuing your shares. So using expensive paper to buy cheaper paper. So that the benefit of being one of the larger guys or larger, particularly the private equity, not the private equity, the property REITs or the property loan stocks or the REITs means that you can essentially issue your shares, which are typically quite highly rated. Okay. As we can see, the earnings per share increased to 420. So what the question is, should we expect the market price of A to increase as a result of the earnings per share? So yes, we would. So the PE ratio should stay the same. 25 times by the new earnings of 420 means that our market value would go to 105, and previously we were at 100, right? So they say that this is seldom the case. Let's see. So the merged entity has not increased its overall earnings at all, only its earnings per share. They say that the PE ratio should be diluted, but I can tell you, in my experience, the PE ratio actually just remains the same. So they say that so they say that there are times when bootstrapping has actually paid off for companies. So your PE ratio remains the same at 25, and 25 times by 420 is 105. What have you guys seen in the market? Have you guys seen companies do this? A lot of the property companies do it. So essentially, if they're trading at a very high multiple or very low earnings yield, they'll essentially buy other companies, and and then it'll help the appreciation of their earnings. Okay. Oh, really? Trellidor. Wasn't Quibus quite a bit bullish on Trellidor? I seem to remember. Was he? Okay. Quibus doesn't know what he's talking about though, so don't worry. Hmm. Okay. Like threw it over the top. Yeah. Interesting. Personal incentives of management. So the classic one is empire building, right? The executive compensation is closely linked to company size. So most managers want to have a bigger company, right? Bigger company means as a CEO, I get a bigger check. Tax benefits. I don't think that this is really that popular anymore. Where you acquire a business with accumulated losses, and then you use those losses to kind of offset your tax liability. I haven't seen that being done before, yeah. So certain tax authorities do not allow this, right? I don't think the South African SARS will allow you to essentially take somebody else's losses and just set them off against your own. So I think that's a tricky one to motivate. They say that unlocking hidden value. So I think that this actually can be quite popular. So to the extent you find an underperforming company, you think that you can get better management, better synergies, reorganization, better incentives for the management team. So a lot of private equity funds do this. They buy the company, they put in different management, they essentially leverage it up a bit, so it runs a bit harder. They put in big incentives for the management team. So management get a very small base, very large stock options. And then typically they maybe do it like a reorganization where they essentially take a division of the business and sell it off or something to that effect. So trying to unlock hidden value or and then let's see here. So cross-border motivation. So I think that this is where you can have certain companies that will trade at higher values in different markets, right? So I know that one of the first transactions that Blackstone did, the private equity fund. They effectively bought a German chemicals company, and all they did was it was an international company, but it was headquartered in Germany, and they actually just moved it to the US. The US essentially valued chemical companies at a higher multiple, and for that, the value of the business actually increased for the same amount of earnings. So, fully exploit market imperfections, maybe to purchase in a country with lower labor costs, to the extent that there's adverse government policy. Let's see, I don't know, technology transfer, maybe making superior technology available. Maybe following your clients. So you purchase overseas companies for new and diverse products that you can bring to the firm. Okay. So I think there's multiple reasons for cross-border. Okay. I think we've been through this example, bootstrapping earnings and calculate the company's post-merger earnings. So I think this is the same example. We get to an earnings per share of 420. We say 25 multiplied by the 420. 25 multiplied by the 420 is 105, but they say this only works in their view. This only works in the short term. I've seen it work quite a bit. So I'm reluctant to, again, stand up here and just kind of repeat this back to you. So we're just going to touch on 1 or 2 points here. So motivations for acquiring businesses in different life cycles. So in the pioneering or development phase, a lot of uncertainty exists around the markets. Firm may not necessarily be making profits, may seek to merge with a bigger business to gain access to capital. So I say here, these types of mergers, conglomerates, horizontal. I'll say a lot of private equity funds do this. So they bring capital to the merger. A lot of uncertainty exists, particularly if there's things like restructurings or venture capital that needs to be done. So early stage. So information is uncertain. Technologies may be unproven. Management team may be not necessarily seasoned, or they may be quite young, or maybe inappropriate. So typically a lot of uncertainty, and you need capital. Rapid growth. So relatively low competition, depending on the technology. You should start to turn somewhat profitable, albeit at a marginal, at a small amounts. Kind of, do you guys think Amazon would fall into this? I was wondering. I mean, Amazon doesn't really have much in the way of profits, right? Very thin profits, because they just tend to reinvest everything, from what I understand. Certainly accelerating sales. They merge to gain access to traditional capital, maybe enable further growth. I think they bought Whole Foods, didn't they? Didn't Amazon buy Whole Foods? Effectively try and access a different market. They wanted to get into, I wouldn't say it would be horizontal, because then it gives them access to things like grocery deliveries and so on. Are they? Yeah, aren't they doing something with JP Morgan or something? Okay. Yeah. Keep it all in house. Yeah. Yeah. Okay. Interesting. More mature phase. Pardon? Mature phase, above average growth, and so obviously there's increased competition. So you may merge to try and increase your economies of scale, increase a few savings, and get a little bit of efficiencies. So naturally, you're going to start to look at things like acquiring some of your peers. Maybe if you want to see some efficiencies, particularly in your supply chain, you may do a vertical. Stabilization phase, increased competition has reduced growth. You try and scale up, take advantage of economies of scale. Hopefully, you reduce costs. Try and expand your base. The bigger you are, maybe the cheaper the cost of capital. So you may get a bit of a financial benefit from having a broader financial base. And then in the declining phase, eroding profit margins, customers' tastes have shifted. You need to try and merge to have some kind of survival. So I think we see a lot of companies at the moment that are actually sitting on cash. They probably made a lot of cash, historically, and now they need to think about, do they want to redeploy it or not, or should they just rather return it to shareholders, right? They want to redeploy it. So we looked at, I don't know if you guys, African Bank. There was a big insurance company in there. So it's called Stangen. So was anybody here part of African Bank? No one. Great. So just in case I say the wrong thing. So Stangen actually made a killing for African Bank. So because you can imagine, they sold things like credit life policies, they sold like short-term insurance on like tables. So nobody walks into like an Ellerines or like a Furniture City or Dial-A-Bed, gets insurance on a table and then actually claims like on the table, right? So the claims ratio was ridiculously low. I mean, so I remember being in chats with the FSB, and they said, you get any kind of request for a claim, you pay it out. You don't even question it, okay? You actually try to pay claims because your claims are so low. So after African Bank went into curatorship, Stangen was kind of left on its own, and it was left with a big pile of cash, and it was left with no more distribution. Didn't have access to client base because obviously Ellerines people had left. So it was interesting to see what they wanted to do, right? So they were entering now into a space in the market where they either had to try and buy a broker network or something like that, try and partner with somebody like Alex Forbes. So, but ultimately, yeah, they were sitting with a ton of cash, and I think all they did was they just decided to return it to the shareholders, yeah, and essentially just shrink the business and just kind of wind it down a bit. So I don't even know if they're still going. Okay, let's talk about the different types of acquisitions, right? So we can have stock purchase. So in a stock purchase, we essentially purchase can take the form of shares or cash. So what we do is, instead of, a lot of companies list for this purpose. So essentially, by having a listed share, they feel like it gives them a bit of currency that they can use to essentially go out there and make other purchases. So, although, sorry, I'm actually referring to the wrong thing here. I'm referring to the acquirer instead of the target. I see that for the target, you can acquire the shares or you can acquire the asset purchase. The methods of payments you can issue as securities, or you can use cash. So, so let's just backtrack a bit here. I was being a bit too fast there. So you can either acquire the shares in the business, and you can obviously acquire it for shares, for cash, or your own shares, right? Why do you guys think people buy the assets out of the business? What are the benefits? Shares versus assets. So at Deloitte, what do you tell your clients? When do you want to buy the assets out of the business? Pardon? The assets should be equal to the shares, shouldn't they? Surely you're buying a business. So the key thing about buying the assets is that you are concerned about things like contingent liabilities, right? Litigations, things that may be tucked in their tax issues. So this is very popular, particularly in things like business rescues. Guys are very concerned that there's going to be liabilities there, creditors are going to come out. So it's a lot cleaner, essentially just buying the assets and the liabilities out of the business, right? So, or just the assets out. You can assume the liabilities. So some guys will essentially buy the shares in the business. Buying the shares is much easier, and you essentially you don't normally, if you buy the assets, then you have to itemize each and every single asset, And so, for example, in the case of, we sold a Dial-A-Bed, you have to go to each one of the pieces of the inventory and allocate a value to them, how much you're buying them for. So it can be a bit admin intensive. The shareholders of the target company are responsible for the tax consequences resulting from the transaction. The taxes are normally in the form of capital gains, right? So you sell shares on the stock market. If you've made a profit, you'll have a capital gain. So let's see here, asset purchase. Payment is made directly to the target company, so you pay into the company for the assets, right? So the money flows. In the case of the shares, the money flows above the business, right? So if this is the business, it flows from shareholder A to shareholder B. In the case of asset purchase, essentially the money flows into the business and the assets flow out of the business, right, to the shareholder. So, and then effectively all that should be left in the business is just cash, which essentially can go towards first settling liabilities and then paid out. So yeah. Okay. Two methods of payment. So you can either use your own securities or you can use cash, right? So to the extent you use your own securities, yeah, you essentially use them as currency, and you formulate what's called an exchange ratio. So I'm going to give you 1 share for each of your 2 shares or something like that. Yeah. Okay. And then you can have a cash offering. So effectively, um, you can pay the target company a set amount of cash for shares in the target. So typically when you have a securities offering, so when you essentially do a share for share transaction, so typically you want a reciprocal due diligence as well. So if I am the seller or the target company, I typically will inherit shares of the acquirer. And so I will naturally say, look, actually, I want to do a bit of a due diligence on you, you know. So naturally, if you are very confident that you are going to make a lot of money out of this, that you're going to have significant benefits and synergies out of the merger, then you don't want to be sharing it with anybody, right? So it's that old saying that if I'm going to be making a ton of money, I want to use debt as much as possible, right? I don't want to be sharing that with anybody. So, if I believe that the merger is going to do very well, I'd rather just pay cash for the other guys. So if I'm using, in the event that the acquirer shares are considered to be overvalued in the market, um, and they're using, let's see here, in the event that the acquirer shares are considered to be overvalued by the market, they will be more inclined to use their overvalued stock to make the acquisition, right? So, yeah. In fact, in the case of Eqstra, I think the acquirer there actually issued shares at about 20 Rand, and I think those shares are now trading at about 12, I think last I heard. So a little bit overvalued. So let's see. So the method of payment will naturally impact on your capital structures. So clearly, if you're having a securities offering, you'll increase the number of shares and dilute the ownership of your current shareholders, right? If you have cash, then you shouldn't have a dilution, right? But it may be financed by debt. So it could increase the amount of leverage in the firm. Okay. Any thoughts, any questions? I think fairly logical, right? So motivations for buying, different types of mergers, when you want to use cash, when you want to use shares. If your shares are trading at a very high multiple, maybe you want to use them as currency because you think that they're overvalued. If you are concerned about the underlying business or liabilities or contingent liabilities, you just want to buy the assets out. If you are comfortable with the potential tax consequences and you're looking for maybe a quick and speedy transaction, you just buy the shares of the business. Let's talk a little bit about hostile versus friendly mergers, right? So what do you guys think? Friendly versus hostile. So friendly, you have the management on your side, right? So you cannot be hostile against the shareholders, right? You can only be hostile against the management team, right? Friendly merger, essentially the target company's managers support the deal, right? So the target managers team directly, and the target management team support the deal. Yeah. They should, yeah, the announcement will be accompanied by endorsements from the target's management team and the board. This will result in a friendly merger, right? So on the other side, you may have a hostile merger. So effectively, you believe that the management team are not necessarily the right team for the job. You do not necessarily want to keep them on board. They probably cost a lot of money. You can probably get some decent cost savings out of them. So let's rather actually just put them back into the pool of excellence, and essentially look to undertake the merger around them, right? So or without their support. So they do not support. So you submit the merger proposal directly to either the board of directors, in which case this is referred to as a bear hug. You can then essentially go directly. The next step is to approach directly the target shareholders. So quite common to do that, right? Just go directly to the shareholders. Funnily enough, I was involved in a transaction with Growthpoint and Redefine, and we were both going after Fountainhead. I don't know if you guys remember. There was a big real estate investment trust called Fountainhead, and I don't. The REITs used to have external mancos. So you used to have a manco over here, and the manco would typically charge like a percentage of the assets under management. So Fountainhead is one of those companies that had an external manco. So that was Fountainhead. So Fountainhead used to own Benmore Gardens, just down the road here. So Redefine Properties essentially came in, and they paid 600 million for this manco. So they bought it from Standard Bank, because Fountainhead was an old Standard Bank real estate investment trust. And so we as Growthpoint thought that we would be a little bit cheeky when we were advising Growthpoint. And we essentially said, listen, we're just going to come out here and we're just going to buy the assets out of the business. Your 600 million, we don't necessarily need a manco. We're just going to kind of cut it there. So naturally, Redefine kind of choked and fell off their chair when we said that. And like I said, absolutely not. Are we going to pay 600 million for something that's a manco of nothing? So they went directly to the shareholders. Yeah. So they went straight to the shareholders. They bought up 51% of the shares. They probably paid quite a steamy price from, I think they went to Ford. They probably went to Allan Gray, I think. And before they knew it, they acquired 51% of the shares. So that effectively gave them, a fully blocking position on us. So we couldn't, because we were essentially just making an offer to the shareholders, right? And essentially they could either accept our offer or accept Redefine's offer. And Redefine just went into the market and just started buying up shares, went to one or two major shareholders and bought their shares as well. So it's quite interesting. They put a newspaper, they put an advert in the newspaper of a dog that was in the kennel. And they named the dog Norbert. And I don't know if you guys know, but the CEO of Growthpoint, his name is Norbert Sass. So I thought that was quite cheeky. So anyway, fun and games, eh? In M&A. So we're going to go through a few little defense mechanisms. A lot of this is just me reading it back to you, so I don't necessarily want to dive too much into it. Things like these are pre-takeover defenses, so you get them in place before the mechanisms. So a lot of companies will speak to their lawyers, they'll get it put in place. So if you have things like a poison pill, so effectively it means that the common shareholder has, so if you try to buy up buy shares in the company will then have a right to issue shares at a much less, at a significantly lesser value, right? So effectively you step into the market, you start buying up shares, and before you know it, the company turns around and essentially says, Tondani, you're trying to buy these shares, and then all of a sudden the company turns around and says, look, I'm going to give to the rest of my shareholders at a significantly discounted value. You coming in here, you're buying up the shares at 100 Rand, I'm going to give to the rest of everybody else for 50 Rand, right? So it totally dilutes you out, right? So when you issue all these new shares. So where the company just issues this, where they just gives the other shareholders the right to buy at a significantly discounted value. And that right is obviously not granted to you as the acquirer. So it will dilute your shareholding significantly, right? A flip over pill, when the common shareholder and the target has the right to purchase shares at a discounted rate in the acquirer. And then a dead hand provision, the poison pills can be only waived by a vote of the existing directors. Yeah, so you need the director's approval. Okay. Um, poison puts. So this can actually be quite common. So uh, if um, if a company makes a play for the equity of the business, so assuming that you just go into the market and you start buying up the shares in the market, if you cross a certain threshold, then all of a sudden all the debt becomes due all at once, right? So everybody that's a bondholder, everybody that's a debt provider says, look, actually I want my money back now. So instead of you're thinking like, look, I'm just going to buy the shares in the business, and maybe the business has a debt to equity ratio of 1, so half debt and half equity, then you could be in a position where you're just buying up the equity, thinking that you're just going to get control of this piece, and before you know it, you have to actually also then all the debt suddenly comes due all at once, right? So so you need a much bigger check. Um, takeover laws that may be restrictive. So yeah, I think just depending on the legislation. Staggered boards where you cannot actually replace the board all in one go. You can only replace a portion of the board, small portion of the board at any point in time, right? So you can say a board has 10 members, maybe you can only replace 2 every year, right? So difficult to essentially acquire the business, put your own board in place, and then essentially gain control of the board of directors. Restricted voting rights. So let's see. So they lose their voting rights. So triggered when a newly acquired block of shares reaches a certain threshold, the shares in the target, they lose their voting rights. So I've never seen this before. I know the JSE is trying to move away from having these differentiated voting structures. My understanding is that they want to try and have, one share, one vote. So you align the economics with the voting. So like, for example, Naspers, I think, has a high-low voting structure. So, and isn't the high voting controlled by the management team? So quite difficult to essentially get them out, right? So here we are. So supermajority voting provisions. So um, maybe sorry. So this is not Naspers, whereby you have to acquire at a higher percentage in order to effect a normal takeover. So in South Africa, I think you need, in order to scheme of arrangement, I think you need 75%. Is that right? So you need you can up that, I think, right, to say 80% or yeah. Let's see if things like fair price amendments. When the merger is blocked, unless a fair price is offered to the shareholders, the price is normally calculated by where you guys issue like a fairness opinion. Yeah. But I mean, in the fairness opinion, it just means that the directors have that, such that they can essentially recommend or not recommend. Mm. Yeah. Okay. Yeah. But that just gives guidance, right, to the market. Yeah. Yeah. So people can essentially say, look, I want to tender my shares, or, interesting. Yeah. And then golden parachutes. So I'm sure you guys have heard about this. Management team get paid huge bonuses. I think the guys at Xstrata, you remember Glencore essentially acquired Xstrata, Mick Davis, I think they got paid out like ridiculous sums, didn't they? I remember hearing that it was in the billions of dollars. Yeah, proper golden parachutes. Post-transaction defenses, I guess just say no is a defense. Yeah. If you don't want to be taken over, like, no. Um, litigation, you can file a lawsuit. Obviously, this can start to become time-consuming and expensive. Maybe try and slow down the process a little bit. You can do what's called green mailing, so essentially instead of blackmail. So Carl Icahn, quite famous for this, right? Essentially, you go to your acquirer, he's purchased 20% of your shares, and you say, listen, actually, I don't want to be taken over. How about I just buy your shares back, right? I'll do a share repurchase. I'll tell you what, I'll pay you a 20% premium, and I'll buy your shares back. So a lot of activist investors have used this, right? So force the company to repurchase your shares at quite a premium to the current value, right? So maybe I guess a share repurchase is relatively the same thing. You can maybe try and up the share price, sorry, up the purchase price by essentially making a tender offer into the market to repurchase shares. leverage recapitalization. So essentially, you take out debt, and you use the debt to essentially repurchase shares in the market, right? So essentially, you're leveraging up the business quite significantly when you do that. So you issue new debt to finance your purchase, your repurchase. So crown jewel defense. So if you have obviously a crown jewel, maybe somebody is trying to essentially acquire your business specifically to gain control of that, maybe technology or special IP, you may rather just sell that off individually, right? And then things like Pac-Man defense, essentially, if Tondani wants to acquire me, I turn around and start acquiring Tondani, right? I haven't really necessarily seen that work. So you make an offer for me, I'll make a counter offer for you. So, and then a white knight defense, very common amongst like Warren Buffett. You find a buddy, find a third party, a friendly third party, and you say, listen, please can you make an offer for my business as well? I don't want to be acquired by this guy that is going to kick me out. And then a white squire is just the smaller version of that. So you just, instead of acquiring me entirely, you just acquire a small piece, like 25% or 30%, such that you can block those particular points in time. So, okay. Compare discounted cash flow, a comparable transaction analysis. So when we are looking to value a target of a company, so I assume a lot of this you probably would have seen. Have you done equities with Cobus yet? Huh? How was it? It's not so good. When you guys make sure when you fill out your surveys, you just rank me and then all the other guys. So just saying. Okay, so let's go through discounted cash flow analysis. Okay, so some of the advantages. So it's relatively easy to model, and you can include expected merger synergies, right? So you're going to map out essentially the earnings, you're going to map out the costs, you're going to map out certain synergies that you're going to be able to achieve, and you can, it's based on more fundamental conditions in the future, and not necessarily on current data, right? So essentially you're going to map out those cash flows into the future and then discount them back. Disadvantages, obviously garbage in, garbage out. Your outputs are heavily dependent on your inputs. Discount rate can have a very large impact on the cash flow valuation, right? So typically we want to do things like sensitivity analysis, maybe scenario analysis. We have a base case and an upside and a downside case. So cash flows are negative. And what do? We look at things like that residual income formula, right? So future earnings estimates are subject to error, right? Very difficult, especially people struggle to predict or forecast even 1 year out, right? So trying to forecast for an extended period up to 5 years, extremely difficult, right? Typically, from those of you that do a lot of financial modeling, terminal value, right? It makes up typically quite a significant portion of the value. And that's highly sensitive, right? To typically things like growth and discount rates. Okay, comparable company analysis. What do you guys think? Easy to do, right? So essentially, access market data, work out an average multiple. You can typically easy to manipulate as well. You can kind of say, I work, our OptiBaby in the private education sector. Look at the multiples. Basically, there's only two, Curro and Advitech. I'd exclude Advitech because it's trading at such a 25 multiple, such a low multiple. And I only look at Curro, and I say 100 times EBITDA is a comparable for our OptiBaby, right? It's absolute nonsense, right? So values derived from the market rather than future earnings estimates, right? So it's what the market is saying about it, right? And the market may be overvaluing that particular share. So the market value of the companies may not necessarily be appropriate. So typically there's not a takeover premium. So takeover premium will need to be calculated. Why would somebody pay a takeover premium? What do you guys think? Control. So to the extent you want to pay up for control, you're going to have to pay a takeover premium. So typically in the South African market, I think it's in the region of about, about 15 to 20, maybe 30%, 20% takeover premium. So merger synergies and changes in capital structure are difficult to incorporate into your comparable company analysis, right? So and then comparable transaction analysis, right? So we look at comparable transactions, M&A transactions of similar companies as our particular transaction, right? So we do not necessarily need to include a takeover premium. So I remember at Investec we actually used to track this. So we used to look at all the deals that happened in the market, and we used to use that as a comparable transactions. So let's see here. So current market values are used. It's unlikely that mispricings could occur. It assumes that M&A transactions are correctly priced, right? So if you are buying into tech stocks, in 1999 and in 2000, you may be inclined to actually pay an enormous premium, which may not necessarily be appropriate, right? Any kind of synergies, again, are difficult to incorporate into this kind of methodology. Okay. So DCF, so obviously any gains for the target company would be essentially the takeover premium. So, and then the price paid for the target over the value of the target. Okay. So gains for the target company are represented by the takeover premium, right? So that's gains for the acquirer. So naturally, you're going to be in a situation where you're going to have the synergies minus essentially the takeover premium that you've paid. So any synergies, so you're going to pay a takeover premium, but obviously you're going to have some synergies that are going to come out of the deal. So to the extent you can achieve synergies that are in excess of the takeover premium, because frankly, you're prepared to pay a takeover premium, but only to the extent that it doesn't strip out all of the synergies, right? Because otherwise you're paying more value than you necessarily are obtaining. So I think we've touched on this already, a cash payment versus a stock payment. We said that if you pay cash, the target shareholders are not impacted by the future, right? They take their cash and they're off into the sunset. They don't really care what happens afterwards. The difference between the cash paid and the share price before the target price, and it's obviously capped, right? They take their cash and they run. So if you have a stock payment, then naturally they will depend. The gain will depend on the future price of the acquirer's company, right? So, okay, so based on this, when looking at a stock payment deal, we need to adjust the formula for the price of the target. So the number of new shares received by the target multiplied by the price of the entity post-merger. So let's see here. So if I say post-merger, the acquirer and the target, expected synergies are 90. A will make a cash offer in the target at $12 per share. So let's see. So there will be 30 million shares, which is essentially the number of shares in the target at $12 per share. So a cash offer would be 360. So the gain to the target company would be, remember, it's the difference between the price, essentially the takeover premium, which is the price minus the value of the share post. So I think that's fairly easy. So it's effectively the value of the takeover premium. They're paying 60. So the gain to the acquirer, remember, synergies minus the takeover premium. So effectively 90 minus the 60 is 30. So gain to the acquirer is 30. So you can essentially say that it's really the synergies that are being divided up here, right? Synergies, some of the synergies go to the acquiring company, some of the synergies go to the target company, some of the synergies go to the acquiring company. So gain to the acquirer represents the difference between the synergies and the takeover premium. The acquirer will give 0.8 A shares per T share. So let's see here. So the number of target company shares in issue are 30,000 times by 0.8. They'll get 24 million new acquirer shares. Target shares in issue post-merger, the 24 plus obviously the 75 that they started with. So there should be 99 million shares in issue. The new merged entity should have a value of, let's see, so the value of the synergies. Let's see here. So you should have the market cap pre, which is effectively, which is that, the market cap of the target company, which is that, and then the total value of the synergies, which is effectively the 90. So the total value afterwards would be 1515 over 99, which is the new number of shares. So you should have 1530 per share of the new company, right? Of the bigger entity. So you can probably work out the value to the actual target shareholders. So if we look at what the target shareholders were paid, you can see here 24 million shares at 1530, so they got 367. So I think that compares a little bit higher, right, than 360 previously. So you can see their gain is 67, right, and the gain to the acquirer is 23, right. So previously this was 60 and 30. Okay, so let's finish off here. Last little bit. So let's just touch on these last few things. Explain how price and payment method of the distribution of risks and benefits in M&A transactions. So both parties obviously want to extract the most in terms of money out of the merger. The acquirer obviously wants to pay the least. The target wants you to pay the most. A cash offer effectively means that the target shareholders are not impacted by the future. They take their gain and that's it, right? The price is capped. Whereas in the instance, if it's a stock offer, they participate in any future gains and losses, right? So the gain is dependent on the future value of the acquirer's company. So the more confident you are that the synergies are being realized, the more you want to make a cash offer, right? If you're going to make an absolute killing in the future, you're going to get big synergies, you want to use cash. If you are a little bit unsure, you want to rather do a stock deal, right? So characteristics of M&A transactions that create value. So they say here that studies have shown that target companies returns gain around 30% after the merger. So acquiring companies stocks tend to fall by 1 to 3%, right? So if you are the acquirer, you typically actually lose value after a transaction, right? So because guys tend to overpay, right? So the reasons for this, why are there as a target, you typically score. As the acquiring company, you typically lose a little bit, typically because guys say that you overpay, the winner's curse, right? So winner's curse, if you are in a bidding war, as the highest bidder, you typically are pushing up the price of the targets and you are overpaying, okay? And then hubris, right? So they think that they know what they're doing. They think that they are God's gift to M&A, and because of that, they overestimate the benefits that the merger will bring to the parties, right? The synergies that they think are going to materialize never do, right? The revenue synergies are never there. Only cost synergies, right? Cost synergies are what comes through. Studies have shown that the longer term acquired companies' stock returns lag those of their peers that did not undergo a merger. So this failure to capture the synergies, right? So let's see. So there are times that the merger results in long-term gains. Acquirers are likely to earn positive returns. Strong buyer, strong performance for the, obviously if the buyer has exhibited strong performance in the past, that will naturally do well. Make sure that you do not overpay, right? So low premiums, takeover premium was low. Less bidders. So if the number of bidders was few, so then the chances that we will overpay is reduced, right? And then naturally, if the market thought that was pleased, if they thought that you were going to do quite well, and they thought it was a favorable thing. Okay. And then last little bit, equity carve-outs, divestiture. You sell, spin off, or liquidate one of your divisions or your subsidiaries. An equity carve-out, you create a new entity, and you sell a portion of that entity to outsiders. Or what you can also do is you can have a spin-off, right? Where essentially you break the company in two, and you essentially take a division and you take those shares and you distribute them to your shareholders. So So effectively, a spin-off is when the old shareholders receive a proportional share in the new separate entity. So you, instead of having one business with two entities inside, you essentially now have two entities and a shareholder base above that owns into each one, right? So they own directly. So typically, if you have quite contrasting businesses, if you have businesses that are quite should not necessarily belong in the same, typically like conglomerates, they do a lot of spin-offs. So split off, I think, is relatively the same thing, given shares in the newly formed separate entity in exchange for some of the shares in their old company. So I think what you can do is you can rather say, look, we're gonna break up the business, and you can either keep shares in the old entity or you can take shares in the new entity, right? And then a liquidation, company is broken up and its assets are sold off piecemeal, right? Normally associated with bankruptcy. Sure, such a little bit on restructuring, huh? Oh, I feel like this is the most beautiful part. So change in focus, companies to refocus itself. So I can tell you that we're looking at a business at the moment. The company is a form of a number of mergers, all just, number of businesses over a number of years just being kind of just jammed together. And because of that, they have not had a proper focus, or the focus has been incorrect. So now we are going to get back to a refocus, a change in focus. So division no longer fits, divisions no longer fit within the company, are sold off. And then things like cash flow requirements, to maybe they sell off a division effectively to raise money for the business. So Taste was doing this, right? They were looking to sell Natal NWJ, Natal Wholesale Jewelers. And then individual parts are worth more than the sum. So what they may say is, look, doesn't Naspers have this issue where effectively their multi-choice assets are not being appropriately valued? The value of Naspers relative to their stake in Tencent is it's at such a discount that they're saying that all the multi-choice assets are not actually being valued. So we need to sell them off or break them out, or maybe do like a distribution in specie or something like that. Okay, so that's mergers and acquisitions. I just want to, just for 10 minutes, last 10 minutes, I don't want to necessarily go through this corporate governance, but I feel it is my duty that I need to essentially just touch on one or two things in here. So a lot of this is effectively just reading. I think it is easy points to get. A lot of the things in here are quite basic. So essentially, what is internal stakeholders? What is external stakeholders? I think you guys obviously know what customers are. You know what stockholders are. I don't think we necessarily need to go through that. Who's on the inside? Who's on the outside? Yeah. So I think that this kind of stuff is quite important. This has become a big focus, okay? Principal-agent relationships, okay? The fact that you have this asymmetric information advantage where the management starts to use this for their own benefit, right? So please, can you guys read through this paragraph? I think it is quite important, okay? So, I mean, things like what is laws, what is ethical, I mean, what is unethical? I think we know that corruption is not necessarily the root of unethical behavior. Yeah, I don't think I need to read that back to you. So I think that there's just a few things here that start to get, these are easy points to get, okay? So Friedman Doctrine, so you want to try and focus on increasing profits to the shareholders, but within the rules of the game, okay? So please just read that. I think if you can read through these three, they're fairly easy to understand. Yeah, and they're good theories to know that if it does come up, then you can crack it. Okay. And then how do you try and implement ethical behavior? Make sure that you obviously don't hire the wrong people, have moral courage. Yeah. So, and then the last one that I just want to touch on for a minute is also on corporate governance. Yeah, so they talk about here about structures, about process, about make sure that you have the right board, the right management team. Make sure they talk about, I think, agency in here as well. So things like, you can see they talk about conflicts of interest issues. So here we are. So things like agency relationships. So again, similar to the previous reading, make sure that you please read this. So between managers and shareholders, and then typically between shareholders and debt providers, right? Between directors and shareholders, agency issues, causes conflicts of interest. Yeah. Like, what is the responsibility of the board? How do you have an effective board? Yeah, so a lot of this, I think, make sure you have an independent chairman, make sure that he's got appropriate qualifications, frequency of meetings. What does it mean? Things like, this is becoming a big issue. This is quite big, in fact, particularly in private equity, right? ESG policies, particularly where you do not have a proper legislative framework, where you have regulatory risk or legal risk. So particularly in Africa, a lot of guys, they want to make sure that you have strong ESG, right? So environmental, social, and governance in place, right? Because you cannot rely on the local law. So, okay. So, and then naturally, you're going to have certain value implications on corporate governance. Guys are willing to pay more to the extent you have the proper ESG in place. Okay. Great. Thanks very much, guys. So, thanks for your time. I'll be around Saturday afternoon if you want to come to Saturday as well. Okay, not Saturday morning. So, because Russ booked me for level 1 on Saturday morning. So we're going to do Saturday afternoon. Okay, cool. Thanks, guys.